Have you ever heard the news saying this company is launching its IPO and wondered what that actually means? Or maybe you have asked yourself, can I invest in it and how do people make money from an IPO? In the next few minutes, I'll explain what an IPO is, how it works, why companies launch one, and the risks you should know before investing. Let's get started. IPO stands for Initial Public Offering. Simply put, it's the first time a company sells its shares to the general public. Before an IPO, the company is owned by its founders, employees, and private investors. After the IPO, anyone can buy its shares through the stock market. Think of it as a company opening its doors to the public ownership. So, how does an IPO actually work? Let's break it down into five simple steps. First, a private company decides it needs more money to grow. Second, it hires investment banks called underwriters to help determine the value of the company and the price of its shares. Third, the company files all the required legal documents with the market regulator. Fourth, the shares are offered to investors. Finally, on the listing day, the company shares begin trading on a stock exchange where anyone can buy or sell them. At that point, the company officially becomes a publicly traded company. Why would a company go to public? There are several reasons. The biggest reason is to raise money for expansion, developing new products, opening new offices, or acquiring other companies. An IPO also increases the company's visibility and credibility. It allows early investors and founders to sell some of their shares and realize profits. Plus, publicly traded companies can use stock options to attract and reward talented employees. From an investor's perspective, IPOs can be exciting. They offer the opportunity to invest in a company's public journey from the very beginning. If the company performs well over time, investors may earn significant returns, and because the shares are listed on a stock exchange, they can usually be bought or sold whenever the market is open. But remember, every investment comes with risks. IPO prices can be very volatile during the first few days or weeks of trading. Some companies don't have a long public financial history, making it harder to judge their future performance. And sometimes IPO shares are priced too high, causing the stock price to fall after listing. That's why it's important to do your research instead of investing based only on hype. Let's take a simple example. Imagine a company wants to raise $500 million. It decides to sell 25 million shares at $20 each. That means the company successfully raises $500 million from investors. Now suppose you bought 100 shares at $20 each. Your investment would be worth $2,000. If the share price later rises to $30, your investment becomes worth $3,000. That's an unrealized profit of $1,000. Of course, if the price fall instead, your investment would lose value. Here are few IPO terms you should know. IPO price, the price at which shares are first offered to investors. Underwriter, the investment bank that manage the IPO process. Prospectus, a document containing information about the company's business, finances, and potential risks. Ticker symbol, the unique code used to identify the company's stock on the exchange. Lockup period, a period usually between 90 and 180 days during which company insiders cannot sell their shares. So, to sum it up, an IPO is the process that transforms a private company into a public company by selling shares to investors. It helps companies raise money for future growth while giving the public an opportunity to become shareholders. But like any investment, IPOs come with both opportunities and risks. So always research before investing. If you found this video helpful, don't forget to like, subscribe and share it with someone who's interested in learning about the stock market. Thanks for watching and I'll see you in the next video.